Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Brynick, and this week I'm joined by Zacks senior strategist, Kevin Cook, who's also the editor of Zacks Tactical Trader, to talk about an item we haven't talked about yet, even though I just noticed it is in the lead to this podcast. It's not, well, we are going to talk about ETFs, but it's not a stock, but we're going to talk about bonds finally. Like, it's in there, and we haven't even talked about it in like a year of doing this podcast. But I feel like that's kind of because bonds have just been on such a run for decades now that you kind of go on autopilot with them. You don't really think. Everybody's still jumping in, investing and all of that. And everybody has them in their portfolio. So why talk about them? But they're in the news again lately. And I've noticed a lot of chatter about the bond market again. But there's been a lot of false, what do you call it? Like calls about the bond market over the years.
Yeah, calling the top in the bond market.
Yes. And everyone's been wrong, obviously, all this time. So what makes this any different? First, I guess, should we talk about like who's making the calls? I guess we should talk about that.
Yeah. I mean, we've seen, Goldman Sachs has been bearish on bonds for a couple of years.
Yeah.
And what they'll do is they'll be wrong, and then they'll just wait till next season. And
right.
It's like
no one seems to care either. Like, oh well, they didn't really get that right.
By the way, they're going to go down this time.
Right.
So I mean, everybody wants to do that. I think we both saw the report from BlackRock last week.
Yeah, Richard Turnell.
Mm-hmm.
He's global chief investment strategist. I actually wrote down one of his quotes. I guess this was in some of his market commentary. And he said, it's time to rethink the role of U.S. Treasuries in portfolios, specifically to be cautious of long-duration Treasuries. The risk-reward landscape for long-duration Treasuries is shifting.
Yeah.
That sounds ominous.
So, are we in a bond bubble? The answer is yes. But there are structural things in place that can sustain this bubble for much longer than anyone expects. One report that caught my eye this month was from a large asset manager called TCW. They're based in LA, and they have total assets under management of $195 billion. So there's somebody worth paying attention to. And this is globally across, all asset classes, stocks, bonds. They do some stuff in alternative investments, and they have offices around the world. So to me, they are extremely plugged in to the global economy and what other asset managers are doing. And their chief of fixed income, Tad Revell, wrote a report on September 19th. So yeah, this was just last Monday, in fact. And then it was published in Institutional Investor magazine. So, and the title of the report was "Twilight of the Central Bankers," because we know that why are bond yields so low, and we can talk about treasuries. I also have some stats on corporate bonds.
Yeah.
But the central banks tend to be the driving force here, because if they keep short-term yields down and they're also buying their own long-term debt, that keeps the long end down. So in this report, Twilight of the Central Bankers, Revell has a great chart in here of, he's looking at the past 25 years of bubbles, and he notes the dot-com bubble getting away from, asset prices getting away from real GDP. Then he looks at the housing bubble of 2007, asset prices once again rising way above GDP. And in his chart, he shows the central bankers bubble, he calls it, asset prices running away from real GDP. So he blames it on central bankers, and they are extremely cautious. They want to. It's not that they want to be the ones to call the top. These guys are actually managing $195 billion, so they have a right to position their clients appropriately. So it's sort of worth listening to them. And we had that spike in yields. The 10-year went up above 1.7% this month. And this was after a former dove on the Fed, who's a voting member, Rosengren out of Boston, said, "Hey, I think we need to talk about having more rate hikes sooner than later." And you and I have talked about this.
Yeah.
It's because one of his favorite indicators is the number of construction cranes that he sees in Boston. And he's starting to notice
a lot
that reminds him of the 1980s, the last bust in real estate. So what his concern is, and why he sort of spiked the bond market, yields higher, so to speak, in before the Fed meeting, was that he thinks if we wait too long, then we'll be in the position of having to do too many hikes too quickly. So he says, so let's get a few more in under our belt now, so we don't have to scare the market later, because he thinks it could really derail the recovery. If you wait and wait, and then all of a sudden, oh my gosh, here's a super strong jobs number, here's a super strong inflation number, now we better raise 50 basis points. That kind of thing could shock the economy by shocking, corporate managers and, people who are involved in CapEx, thinking, whoa, now maybe we pull back.
Yeah, no, for sure. Speaking of central bankers, an ex-central banker, Alan Greenspan, who himself has been involved in various bubbles over the years, even when he was Fed chairman, he was back on the scene. I saw a Bloomberg TV interview with him just about a week ago, and he was calling the bull market in treasuries, and he used the word unsustainable. And he also said he believes the treasuries could rise as high as 5%. I think he's talking about the 10-year here. And then
he's got to be talking 5% yield. He's got to be talking about the 30-year.
Oh, maybe.
Yeah, but still, that would be a dramatic rise.
Super dramatic.
Yeah, it's under 3%.
And he said, this is a classic case of a peak in a speculative security.
Yeah.
But he was also the one who did irrational exuberance during the 90s. So, but he was a couple years ahead. He was right on that one, but it was a couple years too early because the exuberance kept going.
The ironies are incredible, though, because, he was right. And then he's the guy who threw fuel on the fire in 1999 before Y2K,
right.
Opened the spigots on short-term rates and inflated the NASDAQ bubble.
I know.
And then the other thing is where was he in 2005 and 6 and 7 when the housing bubble was going on? He thought everything was fine because he's a huge fan of securitization. In his book, he talks about, hey, we've created this perfect model. We spread risk all over with securitization, and it blew up on us.
So should I be concerned that it's Greenspan joining with like the BlackRock guy, all of these other hedge fund managers, people like they're all on the same
Jeff
side
Gundlach
here.
of Double Line, the supposed new bond king. I'm going to tell you about a better bond king, and that is Scott Minerd of Guggenheim Partners. Guggenheim manages, I think, over $225 billion across equities and fixed income, and this is a guy I've been following for a while. And he's been right for a long time. He's been calling for lower yields for the past 2 years. And earlier this year, when we were having our equity correction in January and February, he said, I think the 10-year could go down to 1%, which was, shocking.
Wow.
And I think that was in conjunction with his call that the S&P was going to go to 1650. So, or there was a chance of it. There was a good chance of it, he thought. So that didn't transpire. I'm going to direct people to his website. You can go to Guggenheim Partners or Guggenheim Investments and look at their August report on fixed income, because I'm going to highlight a couple of things where he's still talking about the 10-year could go down to 1%. First, I just want to talk about corporate bonds for a second. They published a chart using J.P. Morgan data that the corporate bond market issuance is going to break another record this year. Last year, corporations did just over $1.1 trillion in issuance. Well, as of June 30th, the end of the second quarter, they were tracking to hit 1.3 trillion. So the end of June, it was 6.5 or 656 billion in issuance, and so they're on pace here. And why? Because corporations can find a way to borrow cheaply, issue new debt. Especially if they're corporate grade, and buy back their own stock, which is part of what's driving the bond market. So that's one thing you want to see on there. The other thing I want to point out is, so why would Scott Minerd say the 10-year could go to 1%? Well, there's two traps going on right now for anybody who's a bond bear and thinks that the bubble's going to burst, like a Peter Bookvar of the Lindsay Group, who I really respect. You should look up Peter Bookvar. He knows his stuff, but he's caught in the same thing of thinking the bond bubble is going to burst, and it's not happening. There's two traps here. The Fed is trapped, and I've been saying this for a year. they don't want to get away from what Japan and Germany are doing. If they do that, they're going to spike the U.S. dollar.
Right.
Okay. The other trap is that what are global investors going to do with their money? If you are in Japan and Germany, you're not, I mean, if you're forced to buy your own bonds, you will. But how attractive do U.S. Treasuries look at 1.6%? If you can buy the 10-year and get a 1.6% yield when JGBs and the boons are nothing,
negative.
you're going to buy Treasuries, right? And here we are. We just had this spike in yields, but it's coming back off because of election uncertainty. Global money flowing into Treasuries. So the one chart I wanted to show. Go ahead. And
I just wanted to point out for anyone who's not following it on a day-to-day for the 10-year, we haven't actually been over 2% since 2015.
Right.
And it did spike up, as you said, but we're now back down to about 1.56 or something. I think I saw it today.
Yeah.
So it's come back down a little bit, but to get back over 2 would be kind of an accomplishment.
Yeah. So in the August report from Guggenheim on fixed income, they show a great chart which just explains everything. And it's sort of Scott Minerd's rationale for why the 10-year can keep going lower. And what they do is they just plot it against the German Bund over, I got to find this chart here, over a multi-year period. The 10-year Treasury yield tracks the German Bund. Right. So it's the synchronization of global yields, and it's nowhere more stronger than right now because of the first trap I said, where the Fed doesn't want to get too far away from them and spike the dollar. And then just naturally the way economies tend to sink, if they're dipping into recession and we're just holding above it, then, our yields are going to stay high. So he shows a chart of just how closely the 10-year tracks the 10-year Bund. And so while the German bonds could go negative, ours aren't going to go negative, but they're going to track lower, and that's how the 10-year could still really go to 1% in the next 6 months.
Okay, I was kind of looking around to see what kind of money was going into the bond funds, and this would not be from the big hedge fund managers or the institutions, but from regular investors, mom and pops, people like me who don't know really what we're doing, but we would buy bond mutual funds or ETFs as our way of getting in. And for years, everybody's been piling into the bond market, but we've had stocks at new record highs. The NASDAQ has busted out. A couple of the others are very close. So you'd think someone might want to be in equities at some point, but no, because I looked it up, and over the last 12 weeks, the flows into bonds have been on the positive side. So nobody's getting out of that. They keep pulling money out of equity funds. And for the year, and this was through mid-September, and it tracked both mutual funds and ETFs, the outflows from the equity side is $138 billion. Part of that is because everybody seems to be leaving the mutual funds, because over $200 billion left the equity mutual funds, but $60 billion did go to the equity ETFs. So for some reason, maybe because millennials like them, apparently, some money was going into the equity ETFs, but on the whole, money was massively flowing out from equities. But on the bond side, it's taken in between the ETFs and the mutual funds about $160 billion. So people are still diving in there despite these warnings and everything, because it's been such a good performer over the last 20 or 30 years.
Yeah. We talk about how, what justifies the stock market at new highs. And, the math is pretty simple. Number one, these cycles tend to, a bull market tends to end with the trailing PE over 20. So we're getting there. And with the central banks keeping yields down, that drives institutional professional investors and the money, the trillions of dollars that they manage. There's $7.8 trillion indexed to the S&P 500. It forces them into stocks, but it doesn't force mom and pop investors, the individual investor. And so they look at the stock market and they get dizzy of the heights, right? And no, I'm not putting my money, I'm not going to buy the top, but they're not earning anything at the bank.
Right.
So a bond yield does look attractive.
It does. But at some point, are they buying the bonds at the top too?
Yeah.
But they don't think of it.
They don't think of it that way because
nobody's been burned in the bonds in 20 years.
Yeah, because investors think if I buy that piece of paper, it's a guarantee I'm going to get the yield and I'll get my money back at the end. And that seems like a better deal than buying the top in the stock market with no guarantees.
Yeah. But okay, so say you're a mom and pop and you still want to get into the bonds. I wrote down some of the various ways you could play it. Let's say you really think it's going to go towards the one. You believe the Scott Miner, you checked out his report,
Mhm.
and you think it's going to go that way. I looked up some of the just regular ETFs people could be in. There's the 20-year Treasury bond ETF. It's ticker TLT.
Mhm.
Then there's a 7 to 10-year one. iShares has that one. It's ticker IEF. And then there's a 1 to 3-year. I'm not sure would I want to be in that
I
one?
don't think so, because I think that one's going to be the most volatile.
Yeah.
Betting on when is that next quarter point coming from the Fed.
That ticker is SHY if you want to look at that
Yeah.
one.
So being out a little further on the curve for an ETF where they can actively trade it versus being locked in a mutual fund where maybe they can't get
Right.
out.
So you recommend the 20-year, like the TLT
Yeah,
more,
or
so.
the 3 to 7 year stretch of the curve.
Okay. The TLT, since its inception in 2002, is up 68%, but year to date, it's already up 14.
Mm-hmm.
So you can see
that's
why would I not be in it?
Yeah, that's the flight to quality, right?
Yeah.
Is buy what's the safest security on the planet? It's U.S. Treasuries.
Yeah. Okay, let's say we believe Alan Greenspan this time, and we do feel like, it's at its peak, and we're going to go back, at least test that 2% on the 10-year. What are ways I can short these, right, with ETFs as well?
Well, in full
Is that what it's
disclosure, I'll
called?
tell you that I have a position in one of these vehicles, and it's actually levered 2 times. And
Okay.
this is the ProShares Ultra Short Treasury, and it's basically the opposite of TLT, but with leverage. So it's 2 times
2
short,
times.
and the symbol there is TBT.
Okay.
Now, I'm not recommending this for everybody, and we just have a small position in it. But I see I think that the 10-year could go to 2% before it goes to 1%. That's my bet. Now, maybe I'm foolish betting against Scott Minerd because he's been a bond investor for a lot longer than I have, and he knows his stuff. It just seemed that that's the way things were going, is that we're getting towards full employment, and there's the possibility of inflation. So you'll get institutional investors saying, maybe we should get out of bonds now. We got this TCW saying, and it doesn't mean that they're selling all their bonds or going short. It just means they're, strategically, tactically lightening up and finding other ways to earn income.
What do you think of the ProShares Ultra Short, the 7 to 10-year? That ticker is PST.
Yeah, so that's and I think that's another good way to play it, because if the yield curve steepens at all, then that will benefit. And so if we get if we get a December hike out of the Fed, that's going to tend to bump up the middle of the curve too. So
what do you think about that? It's like gone up to over 50% or something.
Oh,
I
has
think.
it?
I think so. The
yeah.
last I saw. Do you really think they're going to do it in December?
Oh,
It'll be the second year in a row we had the December
Yeah.
increase.
It's funny here because I don't want to believe that the election should affect it at all, but
So that's the wild card out there.
Yeah, it is going to be a factor. And the Fed, again, even though they say they're data dependent, the one piece of data that they don't talk about is the trap I said they're in, where they're watching Japan and Germany, and they don't want to get too far away from what those countries are doing, or they're going to spike the dollar, which will cause problems for U.S. manufacturers and exporters.
Is there any kind of gold play if the money is, undecided about where it wants to go, but doesn't want to go into equities? Do you see any of this bond money possibly going into gold or?
Well, gold, tends to be pretty volatile around Fed meetings because it's always, will they or won't they? And so if it looks like, oh my gosh, they're going to hike, then the gold assets sell off. But the trend has been strongly higher this year for the metal and the producers, the miners, and they continue to benefit from this environment. Now, is it logical? Is it rational? As an investment class, I'm not crazy about gold.
Yeah.
But people believe that, hey, you should have a portion of your assets there, and as long as money's cheap, that sector, so to speak, benefits.
I saw a comment from Paul Singer of Elliott Management, who
Mhm.
he said that he recommends investors sell their long-term bonds to prepare for rampant inflation. He's kind of one of the first I've seen actually talking about inflation, because that has been dead for so long. It's
Right.
hard to imagine any inflation.
Right. I have a hard time with the word rampant in
Yeah.
front of inflation
Yeah.
because we're talking about the Fed being data dependent and the guy from Boston, Rosengren, being concerned about the
Right.
real estate market. He's not looking at rampant inflation. He's just saying, I think we need to come a little more off the zero bound to cool off speculation, because this is what happens, right? If I'm not a huge real estate investor. I'm not building any condo buildings, but we try and get in the minds of these people, and we know some of the bigger players here in Chicago, and if they're looking at how cheap can I borrow money for how long, do I start the project now?
Right.
And so that's what Rosengren's worried about, is how many projects are getting started now that will be half built, when the Fed is going, party's over, guys.
Right. Take away the punch bowl.
Yeah.
It's been a while since we heard that, because they haven't taken it away. Remember,
Right.
that used to be like the key phrase. When is the Fed going to take it away? And well, nobody talks about it.
Right. And, I guess in past bubbles, the stock market has sort of led things, but the stock market is not in a bubble in historic terms, right? Because we're just over 20 times trailing PE. We're just over 18 times forward. It's not crazy,
No.
it's
There's not a lot of speculation.
Yeah. So since we don't see it there, and we're not hearing, about excesses in real estate, although you have some stories sometimes.
I've heard some recently. Yeah.
Yeah.
So it's starting to percolate in that area.
It tells me that this can sort of percolate along for another 18 months.
Okay. So we're calling it a bubble, but we don't know when it's going to burst.
Right,
still.
because it's central bank enforced, right? Our central bank, the Fed, has learned from the crises of the past, and so what have they given us? What has worked? It's this slow and steady. We're not getting back to 4% GDP, and we somehow managed to stay above 1% because they let the market know we're there for this economy. We're not going to let it go into recession. And it helps the Fed's case that the rest of the world is doing it too. Obviously, we've got a real live experiment over in Japan. 15 plus years of deflation. The Fed knows they don't want to go there. Bernanke started it. Yellen's carrying it on. They are going to do everything they can not to be Japan.
Yeah. So what kind of advice do you give to people then? Everybody's saying to be cautious here. This could be a bubble.
With equities or bonds?
With bonds.
Okay. I think it comes down to, what's your time frame? What's your risk reward? Junk bonds have come back too, right?
Yeah.
Look at energy. Energy was those junk bonds were going to derail the economy, and we're going to have defaults left and right, and we didn't. And people came soaring back into those bonds, and as a trade, they made a lot of money. So I think you almost have to think a little bit like a trader too, that you can take a position in a corporate bond or an ETF for 3 to 6 months and not be married to it. For investors who think, well, if I just buy the 10-year at 1.6%, I'm guaranteed to get my money back, and that's good enough for me. There are better uses for your money.
Right. Okay, so some of these ETFs too are really short-term kind of trades. Someone shouldn't be buying them to stay in them for years or anything.
Definitely
like
the
that.
one that I'm in, the
Yeah,
TBT,
these ultra short ones.
which is leverage.
Yeah.
That's not something you hold. That's just for a quick trade. Anywhere from 3 days to 3 months,
Okay.
no more. So that's only for very active investor traders.
Okay. Well, this has been a good discussion for our first bond overview. I'm sure we'll be having this one again because, I don't know, maybe we'll have been right or something and we'll do a follow-up.
Yeah.
But until then,
We'll have to title it Greenspan was right.
Right. Exactly.
Or Minard was right.
Right. It could
As the
go
10-year
either way.
goes to
Yeah.
1%.
Yeah. It will be interesting to see. Okay. So I'm going to recap all the tickers of those ETFs again. We had the ultra short 20-year, which is TBT. The 7 to 10-year ultra short is PST. The just single iShare Treasury bond 20-year is TLT. The 7 to 10-year one is IEF. And then the 1 to 3 is SHY. So you be sure to check out those if you're interested. And you can always check out all of Kevin's articles that are on Zacks.com. He's always writing about these interesting topics. And of course, in Tactical Trader, because they are owning the TBT in there, so they are trading it over there. You can check that out as well. For Tracy, I'll see you next week.